The International Monetary Fund and the World Bank have been founded, just like the United Nations after World War II. Why? Mainly because after the war, everyone wanted peace. However, peace on an empty stomach is hard to maintain. So these two institutions were meant to help the economic stability of the world. Both of them are basically banks, but instead of being started by individuals, like regular banks, they've been started by countries. Most of the world's countries are members of the two institutions, but of course, the richest countries are those who handled most of the financing, and ultimately, those who have the greatest influence. The IMF and the World Bank were designed to complement each other. The IMF's main goal is helping countries which are currently in trouble, and who cannot get money by other means. Perhaps their economy collapsed, perhaps their currency is in danger. The IMF, in these cases, is kind of like a lender of last resort, who you go to when nobody else is willing to give you money. The World Bank, in comparison, has a more long-term approach. Its main goals revolve around the eradication of poverty, and it funds specific projects which help them reach these goals, especially in poor countries. Unfortunately, the reputation of these institutions has been dwindling, mainly due to practices such as lending to corrupt governments, or even dictators, and imposing ineffective austerity measures to get their money back. If run properly, however, they definitely could help make the world a better place.
Global trade depends on the smooth exchange of currencies between countries. Businesses rely on predictable and stable mechanism. This module takes a look at the recent history of global monetary system and how they have evolved over the past 2 centuries. While the current monetary system continues to evolve, lessons learned over the past 50 years help determine the best future options. As part of World War II monetary environment, two institutions were created. These institutions have expanded to play an increasingly larger role in the world economy. What is the International Monetary System? International Monetary System refers to the system and rules that govern the use and exchange of money around the world and between countries. Each country has its own currency as money, and the International Monetary System governs the rules for valuing and exchanging these currencies. Why do economics need money? This chapter defines money as a unit of account that is used as a medium of exchange of transactions. Without money, individuals and businesses would have a harder time obtaining or exchanging what they need, want, or make. Money provides us with universally accepted medium of exchange. Before the current monetary system can be fully appreciated, it's helpful to look back at history and see how the money and system governing the use of money have evolved. Thousands of years ago, people had to barter if they wanted to get something. They worked well if the two people each wanted what the other had. Even today, bartering exists and remained the most common form of exchange and trade.
So let's proceed to the brief history of international monetary system. History shows that ancient Egypt and Mesopotamia began to use a system based on the highly coveted coins of gold and silver, also known as bullion, which is the purest form of the precious metal. However, bartering remained the most common form of exchange and trade. Gold and silver coins gradually emerged in the use of trading, although the level of pure gold and silver content impacted the coin's value. Only coins that consist of the pure precious metal are bullions. All other coins are referred to simply as coins. It is interesting to note that gold and silver lasted many centuries as the basis of economic measures, and even into relatively recent history of the gold standard. Fast forward 2,000 years and bartering has long been replaced by a currency-based system. Even so, there have been evolution in the past century alone on how Globally, the monetary system has evolved from using gold and silver to represent national wealth and economics exchange to the current system. Pre-World War I, gradually more countries adopted gold, usually in the form of coins or bullions, and this international monetary system became known as the gold standard. This system emerged gradually without the structural process and more recent system. The gold standard in essence created a fixed exchange rate system. Note, an exchange rate is the price of the one currency in the terms of a second currency. In the gold standard system, each country sets the price of its currency to gold, specifically to 1 ounce of gold. A fixed exchange rate stabilizes the value of the currency vis-a-vis another and makes trade and investment easier. The gold standard eventually collapsed from the impact of World War I. During the war, nations on the both sides had to finance their huge military expenses, and they saw by printing more paper currency. As the currency in circulation exceeded each country's gold reserves, many countries were forced to abandon the gold standard.
Hello everyone, I'm Marjorie Fajardo Marino, PSB Marketing Management second year student, and I will going to discuss the history of IMF or International Monetary Fund in World War II. The IMF or International Monetary Fund was established in 1944 in the aftermath of the Great Depression of 1930s. 44 funding countries sought to build a framework for international economic cooperation. Today, its membership embraces 190 countries with staff drawn from 150 nations. Then how did the international monetary system start? The Bretton Woods system was established after World War II and was in existence during the period of 1945 to 1972. In 1944, representatives of 44 nations met at Bretton Woods, New Hampshire, and designed a new post-war international monetary system. Then why was International Monetary Fund created right after the World War II? IMF, UN specialized agency founded at the Bretton Woods Conference in 1944 to secure international monetary cooperation, to stabilize currency exchange rates, and to expand international liquidity. In 1944, Bretton Woods Conference, which created the International Monetary Fund and the International Bank for Reconstruction and Development, was a major landmark in international cooperation. However, the Bretton Woods system came under increasing pressure in the 1960s due to lack of a reliable adjustment mechanism to manage payment imbalance, as well as the persistent asymmetry in the balance of payment pressure faced by surplus and deficit countries. In 1971, the system effectively collapsed when the US government suspended convertibility of dollars into gold for other central banks as the decision that will prove to be permanent. The system that involved to replace it can be viewed as a non-system with the diverse ad hoc arrangement. Viewed overall, this non-system has proved to be fairly resilient, but some of its major gaps continue to have negative effects on the global economy. The IMF has played a part shaping the global economy since the end of World War II. Cooperation and reconstruction in 1944 to 1971. As the Second World War ends, the job of rebuilding national economies begins. The IMF is charged with overseeing the international monetary system to ensure exchange rate stability and encouraging members to eliminate exchange restriction that hinder trade. In 1972 to 1981, the end of Bretton Woods system. After the system of fixed exchange rates collapsed in 1971, countries are free to choose their exchange arrangement. Oil shock occurred in 1973 to 74 and 1979, and the IMF stepped in to help countries deal with the consequences. In 1982 to 1989, deep and painful reforms. The oil shock leads to international debt crisis, and the International Monetary Fund assists in coordinating the global response. While in 1990 to 2004, societal change for Eastern Europe and the Siam upheaval, the IMF play a central role in helping the countries of the former Soviet bloc transition from central planning to market-driven economies. While in 2005 to present,
Role of the International Monetary Fund in the World Bank. The International Monetary Fund and the World Bank, often called the Bretton Woods institutions, are the twin intergovernmental pillars supporting the structures of the world's economic and financial order. Both have taken on expanding roles, and there have been renewed calls for additional expansion of their responsibilities, particularly in the continuing absence of a single global monetary agreement. International Monetary Fund officially came into existence in December 1945 with 29 members, and today have 187 countries are members of the IMF. The IMF is responsible for the creation and maintenance of the international monetary system. The system by which international payments among countries take place. It provides a systematic mechanism for foreign exchange transaction in order to foster investments and promote balanced global economic trade. The IMF focuses and advises on the macroeconomics policies of a country, which impact its exchange rate, governmental budget, money, and credit management. The IMF will also appraise a country's financial sector and regulatory policies, as well as structural policies within the macroeconomy that relate to the labor market and employment. In addition, as a fund, it may offer financial assistance to nations in need of correcting balance of payment discrepancies. The IMF is entrusted with nurturing economic growth and maintaining high levels of employment growth within countries. How does the IMF work? IMF is funded by quota subscription paid by member state. The size of each quota is determined by the size of each member's economy. The quota in turn determines the weight each country has within the IMF and hence its voting rights as well as how much financing it can receive from IMF. 25% of each country's quota is paid in the form of special drawing rights or SDRs, which are claimed on the freely usable currencies of the IMF members. Take note, the SDR is not a currency. It is a unit of account by which member states can exchange with one another in order to settle international accounts. The benefits of IMF offers its assistance in the form of surveillance, which is conducted on a yearly basis for individual countries, regions, and the global economy as a whole. Three types of IMF loans. First, standby arrangements. Offer financing of a short-term balance of payments, usually between 12 to 24 months but no more than 36 months. Second, extend fund facility is a medium-term arrangement by which countries can borrow a certain amount of money, typically over 4 to 10 years. Last, poverty reduction and growth facility. As the name implies, it aims to reduce poverty in the poorest of member countries while laying the foundations for economic development. The purpose of this IMF is to ensure the stability of the international monetary system of exchange rates and international payments that enable countries and their citizens to transact with each others. Here are the purpose of the International Monetary Fund. To promote international monetary cooperation through a permanent institution which provides the machinery for consultation and collaboration on international monetary problems. To facilitate the expansion and balanced growth of international trade, and to contribute thereby to the promotion and maintenance of high levels of employment and real income into the development of the productive resources of all members as primary objectives of economy policy. To promote exchange stability, to maintain orderly exchange arrangements among members and to avoid competitive exchange depreciation. To assist in the establishment of a multilateral system of payments and respect of current transaction between members and the elimination of foreign exchange restriction which hamper the growth of world trade. To give confidence to member by making the general resources of the fund temporarily available to them under adequate safeguards, thus providing them opportunity to correct maladjustment in their balance of payment without resorting to measures destructive of national or international prosperity. In accordance with the above, to shorten the duration and lessen the degree of disequilibrium in the international balances of payments of members.
Good day, everyone. My name is Roslyn Montijo, and my topic for today is the World Bank and the World Bank Group. The World Bank came into existence in 1944 at the Bretton Woods Conference. Its formal name is in the International Bank for Reconstruction and Development, or IBRD, which clearly states its primary purpose of financing economic development. The World Bank has one central purpose: to promote economic and social progress in developing countries by helping raise productivity so that their people may live a better and a fuller life. In 2009, the World Bank provided $46.9 billion for 303 projects in developing countries worldwide, with financial and technical expertise aimed at helping those countries reduce poverty. Today, the World Bank consists of two main bodies: the International Bank for Reconstruction and Development, or IBRD, and the International Development Association, or IDE. The World Bank is part of the broader World Bank Group, which consists of five interrelated institutions. Number 1, International Bank for Reconstruction and Development, or IBRD, which makes loans to countries with the purpose of building economies and reducing poverty. Number 2, International Development Association, or IDE, which typically provides interest-free loans to countries with sovereign guarantees. Number 3, International Finance Corporation, or IFC, which provides loans, equity, risk management tools, and structured finance with the goal of facilitating sustainable development by improving investment in the private sector. Number 4, Multilateral Investment Guarantee Agency, or MIGE, which focuses on improving the foreign direct investment of the developing countries. And the last one is number 5, International Century for Settlement of Investment Deputies or ICSID, which provides a means for dispute resolution between governments and private investors with the end of goal of enhancing flow of capital. The current primary focus of the World Bank centers on six strategies themes. A. The poorest countries, poverty reduction and sustainable growth in the poorest countries, especially in Africa. B. Post-conflict and fragile states, solutions to the special challenges of post-conflict countries and fragile states. C. Middle-income countries, development solutions with customized services as well as financing for middle-income countries. D. Global public goods, addressing regional and global issues that cross national borders such as climate change, infectious disease, and trade. E. The Arab world, greater development and opportunity in the Arab world. F. Knowledge and learning, leveraging the best global knowledge to support development. The World Bank also is a vital source of financial and technical assistance to developing countries around the world. We are not a bank in the ordinary sense, but a unique partnership to reduce poverty and support development. The World Bank Group comprises 5 institutions managed by their members countries. Thank you.